YouTube.
You are eating the space. I should start the gym.
Yo, what's good, guys? Welcome back to a brand new video of the Bestfriend trading. So today in this episode, guys, I'm going to be teaching Mr. Yaga right here a very simple strategy he can use to make, I don't know, any amount of money that he wants from the market. This is a very simple strategy, guys. I want to teach it to him, and the same way you guys will be learning. So make sure to hit the subscribe button, like, comment, and don't forget to subscribe and subscribe, guys. And make sure to like this video. The more you like the video, the more YouTube.
You are eating the space. I should start the gym.
So guys, as you can see, this is our screen. Yeah, you need trading view, of course. If you're trading and you're not choosing trading view, I don't know what you're on, guys. So this is a simple strategy. Most of you really always have a time when you're analyzing the markets, but I want to show you when I'm teaching my boy right here on how we can be able to analyze charts very clearly. So the first thing, Yaga, this market moves in three ways. It's either going to the uptrend, downtrend, or the sideways market. So if it's in a sideways market, that one we call it a ranging market. Yeah. So most of the times, the one that we see all the time is an uptrend or a downtrend. So if it's an uptrend market, the market never goes like in a straight line like this. It never goes in a straight line. This. It has to higher. It has to form those things. Where do I even choose this from? I think right here. Yeah. So market has to go like this, if it's going in an uptrend. So in this way, it's forming what we call higher highs and higher lows if we're on an uptrend. But if we're on a downtrend, it's going to be forming lower lows and lower highs. So market has to be coming like this. See? Now today we are going to learn about how to use the Fibonacci, since we have impulsive moves every time. So and then let me first show you what an impulsive move is. So an impulsive move. So let's come back to this side here where there's nothing. So whenever we have price going up, so this is what we call an impulsive move. That is an impulsive move. Yeah, that's a very long move. So this happens every time in the market. Then the retracement is just a mere pullback. So that price keeps on going back to the upper side. Again, retracement, and then again price goes back up like this. So the process just keeps on happening. And I can show you the same thing. I can show you literally the same thing. Let's see. As you can see right here. As you can see here, it's not a very clear market. You know, most of the times you won't receive something that is very clear. You see, something like this. You see, all these are small pullbacks, mini pullbacks. You see, but I'm going to show you. I'm going to show you more clear things as we go on. Let's see. We have also another one right here, like this. You see. Then again here, then again like that. You see. So it just keeps on happening like every time. So one of the best ways we can do to find trades now, since this is an uptrend market, if this is an uptrend market, then we're going to be looking for only buys. We use our Fibonacci retracement. So if we use our Fibonacci retracement, we apply this Fibonacci retracement from the swing low to the swing high. So when you choose a Fibonacci like this, you place it from the swing low like this to the swing high. So this is the swing high right here. So you swing high like this, and make sure it sits on the top like this. Yeah, just like that. So now this is what we have here. So whenever I have impulsive moves shooting to the upper side, I have a retracement coming in, and most of the times retracements come into levels where market has already been, they come back to a level. You should just note these levels. You have the 0.5 level, which is this one right here, and then you have the 0.6 level. So basically an impulsive move is like 100%. So we want to know how much of the 100% will price come down, what percentage. Most of the times it's 50% or 0.6%, depending also on the waves. So we'll have what we call area waves in the market. Wave 2, we have wave 2 and wave 4 sticking out most of the times, but wave 3 is the longest. So most times when wave 3 is retracing, it doesn't retrace like these other ones. Most of the times it stops at like 0.38.
Okay.
So now let's so this is just on an uptrend market. Let me show you also on the downtrend market before we jump onto the live markets. So I'll remove this. Let's come back here. Now, so when the price is coming in a downtrend, basically it's going to come. Now, impulsive move to the downside, retracement to the upside.
And then another big pull.
Yeah, like this.
And retracement.
Yeah.
And another pull.
So the process just keeps on happening every time. So for us, we're looking for sells in the market. So when you're applying a Fibonacci retracement, you're going to apply it from your swing height and your swing low. Yes. Now we apply like this. We choose your Fibonacci retracement, apply it to your swing high, the swing low. So the swing high is the highest point price has been to before it came down. So you can see when here price reversed at 0.6 level. Yeah, but this is just like a sample, what to expect in the market. So we're going to start with the Euro USD market. We have seen the Euro USD market as one of the perfect markets, and the reason why I trade the Euro USD market so much is because it gives us clear, impulsive moves and retracements, and also it's the most traded currency pair in Forex. So we're going to be looking at Euro USD, and the reason for the Euro USD, as you can see, this is a clear market that has been giving us impulsive moves and retracements. So I'll show you a sample right here. Actually, let's choose this. Then let's make it a full screen so I can see very clearly. So you can see from here, right here, impulsive,
then
retracement to the upper side, impulsive, and then retracement. And this is the Mia, so I won't count that on. So I'll get into impulsive. So meaning you expect a retracement coming in. So now we're going to try and find this retracement coming into the market, and then we shall be able to take our trade. So this is like one of the simplest ways I can just wake up and make $1,000, even though I want to make $5,000 in the market. As long as I'm patient with the market coming back to me.
To your zone.
Yeah. So this is a daily time frame. When we're going in for our entry, we shall use a smaller time frame. You can be zooming into the 4-hour time frame, 1-hour time frame, and see what is price giving us. But since you're here, I just back testing. Let me show you. So now, since we have an impulsive move, right? So I've already identified the impulsive move is from here. Now you see price is trying to retrace. How do you see price is trying to retrace? You can see it's starting to form reversal candles. You can see, so it's starting to push back up. So if price is pushing up back up, then what we're going to do, we are going to choose our Fib retracement. Our Fib retracement is this one, as you can see. Swing low. I mean swing high to swing low. Yeah, swing high to swing low. Then also, remember I said price only comes back to the zone where it has been.
It has been, yeah.
So this is a price where price has already been. So
0.6.
Mark that level right here. This is the level right here. So when we remove this, we're going to see that price has already been here. So this was a support level, price breaks, it's a resistance. So meaning price, this is like basic, price has come back and retest that. But you need to have like a strong confirmation. One of my strong confirmations is whenever I have like big candles coming into the market like this, it means we have to mark out the fair value gap that has not yet been filled. So fair value gap is this gap between here. You see this gap right here.
From this week to the other week.
Yes. So we're going to mark out that gap that has not yet been filled. So that when price is retracing, it comes back and fills up that gap. So now I'm going to put back my Fibonacci retracement, and this is like even more amazing that the levels where we expect price to reverse from is the same level between
0.06
and 0.5.
Yeah.
So when you choose this tool here, this is a
rectangle.
So I'm going to place it in between 0.6 just there and 0.5. So now I no longer need my Fibonacci. I'll remove it like this. You can see now this is something very clear. This is not basic, not everyone knows about fair value gap. And this now you have a strong confirmation. What I want now is price to come back and retest, but I want it to just
fill
up the gap, and then I see
where the
rejection. Yes. Remember, this is a downtrend market, and we are only looking for sells. Yes. Now, so we're waiting for price to come back here. So now this is another aspect. You need to wait for price. Since this is a daily time frame, this can take days. As you're waiting for price to come back to your level. But after sudden price will always come back to you. Yeah, if you're already patient. So this is what always happens. You can see price comes, it moves. As you can see, price filled our levels right here. You can see, and even it gave us a rejection candle. This rejection candle right here. This is why it's always good to know about all the candle patterns on your fingertips. Yeah. You can see. Then you have also this big red momentum candle. So, wherever the gap has been filled, now we're going to go in. As you can see, we're going to. So this is how we set our targets now. Since now price has given us confirmation. Remember, this is a downtrend. We have not yet seen signs of price reversing. Yeah. So now what we do is you're just going to zoom like this, and then you're going to come here. So now we are going to select short positions like this. And what I like about this is whenever I put your stop loss, price never goes back to hit it because it respects this downtrend market. Like this. So let's say we enter from this candle right here, this next one right here that has already formed. Let's say it has not yet formed, so we put our stop loss just above right here. As you can see,
so above the candle where to close.
As you can see, we're risking only 93 pips. And then how do you measure your target? Your target, you measure the distance between here to here. Between here to here, we measure out to the previous impulsive move. So if this is, I think this is like 400 pips, you know, I can just count from my head. Let's see and see. It's even more. This is 600 pips. So what we are going to do, you're going to measure 600 pips right here. So you can even just look here, they'll be counting for you then. Let's reset it. So right here, this is 600 pips.
Yeah.
As you can see, so now you already have everything that tells you that's what price is going to do. You have your stop loss. You don't freak out when you see price moving around. You stay into the market until your take profit is hit. You know, because you can even see now we have big impulsive moves are coming into the market. This is a high profitable strategy that I always use. So you let your price play until your take profit is hit. You don't freak out just seeing those small, you know, near interest coming into the market. So what you do is just keep on increasing, you know, like this. Then
to see.
Yes, you let your price play until your take profit is hit. As you can see, our take profit was hit. Price never reversed back to hit our stop loss. So this is key. You see, I've only risked 93 pips
for 600
pips. So guys, if you're trading on a huge account, you're only risking 1% of your account. You know, to make, I don't know, this is a very big percentage. This is let's see, this is a very, very good risk to reward trade, guys.
Imagine risking $100
yeah. Guys, imagine when you have, like, let's say $10,000 account, you're risking $100 to make $600. So meaning you have made 6% of your account, you know, if you're risking small. For those high risk guys, you know, so this is how you so this is a very simple strategy that we already use in the market, you know. The other strategy, we can just draw trend lines. So since this is a downtrend market, so I'll show you that. So since this is a downtrend market, now we shall remove this. Let's first remove this. Now since this is a downtrend market, you see, what you do is just simply draw the trend line like this, connecting just points like this, you can see.
So you wait for it to tap the trend line.
Nice.
And then
yes. So for those that don't know how to use the Fibonacci trace method, they can just wait for price to touch the trend line. So you can see this is the point where, again, that's the same point we take the trend. This is the same point you can even see where price rejected the trend line. And what it did give us, it gave us, as you can see right there, it gave us what we call an engulfing, a bearish engulfing candle pattern. You can see right there. Or some people can even call this an evening star. You see, you have this big candle, small candle, and then a big red candle. This is an evening star pattern, guys. You take your trade here, put your stop loss just above that, and wait for the price to come. Even though you didn't have entry here, you wait for price to come back to
the same level.
Take your trade there. You know, put your. That's the thing. So this is a very easy strategy. I hope you have understood. I hope you use it, and you know, flip those small accounts as much as
big
accounts you want. So, guys,
today I'm a student.
So guys, if you have enjoyed this video,
please make sure to subscribe.
Simple strategies, guys. More and more are going to be coming in like this. You know, you don't need to complicate trading.
So from today onwards, I'm the student.
I'm going to be teaching him these simple things, and I hope you guys also understand them.
I'm the student. So, you see, students are small, teachers are big.
Kawaga. So guys, make sure to subscribe, and we shall see you in the next video.
Assalamu alaikum.